right, hey, welcome to Generational Bonds. I don't know. It's a working name, right? If we come something better, we'll put it in the next one. But welcome to Generational Bonds for now. I'm Anthony, and I'm here with Willie. So maybe just a bit about ourselves, given that it's the first show. What we do here, well, we are just I'm a host at Market Updates. Equity is getting a bit boring, very depressing. So I don't talk about something else, right? So bonds it is, given the use now. But Willie, how about you? Can you tell us a bit more about yourself?
Okay. My name is Willie, and I run a financial blog called Dividend Titan. Before this, I was a credit analyst, so a bonds analyst. Reading through hundreds of pages of bond prospectus. Yeah, that's terrible.
No wonder you quit and found a new job. I completely understand.
So that was what I do. And today, I move into a different form of income, which is on dividend investing, and that's my financial blog. But of course, at heart, I've always loved bonds because that was like my first job out of school.
Oh, so it's like a first love, and hopefully we rekindle some flames, and we can talk a bit more about how to get income besides just REITs. Right?
Yeah, I mean you can never forget about your first love, right?
Don't tell our wives that. Okay, yeah, but I think as people know and as the name suggests, so we are really just here for now to talk about bonds, right? So that there's this whole shift, right? With the interest rate environment, with the macro environment, and if you don't know what we are talking about, go listen to Market Updates. But if you do, stay here. And at the end of the day, bonds are, I mean, we are both relatively young, but bonds are increasingly becoming relevant just because they offer greater yields, they offer a bit less volatility, right? So there's this whole de-risking and this whole and we can talk about allocation and all that in subsequent episodes, which becomes very important. But I think that this is definitely useful as we kind of shift into a new era of what investing is, rather than just buying growth, buying FANG, buying S&P 500 and DCA it, right? Maybe we can be a bit more tactical. Maybe we can get better risk-adjusted returns, and that's why that's why I'm here to learn a bit more about this. I don't know why you're here, but that's why I'm here.
Yeah, I mean, for me, bonds has always been something which I love because it gives really a steady cash flow and all that kind of income. And this is something which I always, as an investor, I know I don't just look at stocks, but of course other asset classes as well. I think it's something which always intrigues me. All right, and don't forget, the bond market is actually much bigger than the stock market itself.
Oh, okay.
Yep. So many people think that stock market, is the world's largest financial market in the world, but that's not true. If you see that the biggest $1 trillion market is the bond market, if you also include the government bonds or the government debt all over the world, so it is a huge machinery of the financial world. Yeah.
I mean, I can kind of see that given how many US government bonds were issued in the past year. So even if they weren't, they should be by now. But yeah, I mean, I totally get your point. I think it's, to me, the problem has been that this market is something that is really very institutional, right? So you'll see, funds going, oh yeah, we have different bond allocation and tactical switches, right? Depending on the broader environment. But it's something that I think retail maybe doesn't have as much exposure to, right? I mean, nowadays you have endowers, you have Bond Supermart, they can go and research if endowers to buy bond funds. So please come and sponsor us, thank you. At the end of the day, it's something that, I mean, even for me personally, right, maybe I can buy one or two bonds, but I think with the way the markets have been going, it hasn't been it has never been technically a good position to be in, right?
Do you buy bonds yourself, Anthony?
No, I don't. I mean, I look at the ticket. I look at the minimum size in Singapore, right? It's like what 250K, 200K. It's like, wow, I can buy a car. I can put a down payment for a house. My BTO, I can buy half a BTO. Right? So and then in the end, I buy one bond. Like, huh? Are you kidding? And I don't know enough about it. I think that's the fundamental problem, right? It's so big. And because it's so big, you need to learn more. You need to research more. You need to kind of understand what it is, right? Because you're not going to throw. I'm not rich enough to throw 250K away, lah. Yeah. So and that I think is why I'm here, so that I can learn more and maybe get a bit more confident in dealing with these sort of products.
Yeah, I think what's what's interesting, which I've just mentioned, Anthony, because bonds are actually huge, right? Like you have to spend $250,000 to just buy one bond. But what many people don't understand is that it's not just those bonds which are looking at, but there are also other bonds which we can focus on, right? Like our government bonds, you have your retail bonds, which are much smaller in size, and that also allows investors like yourself and myself to actually participate in. And like what you rightly pointed out just now, with rising rates, interest rates are going up, the yield is going up.
Yes.
And that's actually making
That's brilliant.
bonds more attractive. Don't you think so?
Yeah, I don't know. I mean that's kind of always the attraction of not only bonds, right, but even like income investing. You get cash for doing nothing. I mean, you talk about passive investing, passive income. Buying a house and renting it out is not passive income. I'm a tenant. I'm a very irritating tenant. I'm sure I'm not. My landlord doesn't find me passive investment, right? So or at least her agent doesn't find me something like you have to spend money to get a return. Whereas a bond, I mean, and we can talk a bit about whether you trade or you hold bonds to maturity. But at the end of the day, you buy and then they pay you interest, and then if all goes well, they pay you a principal at the end. Right? And you literally sit there and do nothing. There's no real transaction cost involved. Unlike, let's say, buying and selling shares, where it's kind of cheap now with like IBKR, Tiger, and all that, but you still have transaction costs involved, right? Here, you're just kind of holding it and waiting for money to roll in. I mean, I like that. I really like the idea of
who doesn't like it, right?
sit down, funny from the sky, good. Yeah, but okay, so before we get into the real details, right? Just very, very basically. I mean, we talked a bit about this government bonds and all that. So who actually issues bonds and what are bonds?
Yeah, so maybe just get down to the basics of bonds, right? So what are bonds? So bonds are basically your debt. So when you own a bond, right? Let's say, Anthony, if you buy a bond today, you are actually owning a company's debt,
Okay.
right? And it is not like stocks, because stocks, you are actually owning a piece of that business. But you don't, as a bond holder, right? So you don't get to participate in the company's profits. Unlike a shareholder, if the company makes money, as a shareholder, you will make money as well. But as a bondholder, you don't. But where you make the money from is that the company pays you a half yearly or an annual interest rate, also called a bond coupon. And this is legally rightful to you. So in legal terms, you are guaranteed that coupon unless the bond fails or unless the company defaults. Right?
Okay. So I'm like the loan shark. I lend them money, right? I mean that's essentially it, right? They owe me money, so I've lent them money, and they and they're supposed to pay me back half. Every half yearly, quarterly, annually, depending on the coupon. And and they call it a coupon because I think 40 years ago, you literally had to cut the coupon out from the bond and present it to get your interest. And because people forgot to mail them in to get interest because mail 40 years ago was slow, there were service providers set up, which I think is the current Fidelity actually, to actually help people mail their coupons and then get a cut of the proceeds return, right? So I think that's a bond coupon. And it's actually what it is lend them money, they will return you. If they don't return you, then you go sue them like any other debt, right?
Yeah.
It's essentially I think a debt instrument, just that now it's listed and you can trade and all that, rather than let's say lending to all those private lenders or lending to what was that? All those fund aggregators. I think now crowdfunding.
Crowdfunding,
right?
yep.
Which is also another form of debt. With also, and you can kind of see their interest payments to you as coupon. But at the end of the day, this is listed. I think they tend to be bigger companies. The issuers tend to be bigger companies, and of course they issue greater amounts of debt.
Yep.
Yeah. So wait, that means that if the government issues bonds. So for example, if the Singapore government securities, right? That's essentially Singapore government owe me money.
Yep. So in this case, if a company issues you, let's say a company issues a bond and you buy the bond from the company owes you money, right? So like what you say, you are the loan shark now and you are a bond investor, right? You are a bond investor. Now, if the government, so let's say our government, the Singapore government, issues a bond and you buy the Singapore government bond, you are actually lending money to the Singapore government. So you are a bond owner or bond holder of the Singapore debt. And this is a very interesting idea here, because a lot of countries, if you see, that they actually need money, right? there's many ways you can actually get money. Number one, through tax revenues. Number two, through investments from other countries. But number three, you can actually, government can actually raise money from its own people, through borrowings and bonds. And this has been for the longest time. It has happened, over the last 300 years. Because if you think about it, the first bond issuance was actually in Vienna, where they actually raised bonds to service the war. Like, for example,
World War One, right?
yeah. So way before that. Also, at the same time, bonds are also the same instrument which helps to pioneer, travel across the world. If you think about it, the Dutch East India Company, when they first started, they had to raise money from its own people. And they don't just raise money from shares, right? They also borrow money from its own people in terms of bonds. So bonds have actually been a very powerful tool to finance a lot of operations, in terms of businesses, in terms of the government operations as well. And that's the beauty. And what's more interesting is, Anthony, just before I came here, right? So I was just reading about the highlights of the week. And one thing which really caught my attention was this rumor of China going to open up its zero COVID policy. I'm not sure if you've actually read that.
I think I read that, and then somebody said actually that's a completely false rumor. It doesn't happen that way.
Yeah, but the funny thing is that it actually caused share price to actually go up, right?
Yeah.
But before that, share price, Chinese stocks were all battered. They were all sell off, and there's always this up and down kind of movement. Now, the beauty about bonds is, right, despite all this news, despite all these rumors, you don't really have to bother about all this, because what bonds have is that they have this thing called the maturity date. Now, when I buy a bond, or when you buy a bond, at the end of, say, a certain number of years, the company or the government is going to repay you whatever money you actually lend them. And it is guaranteed, unless the government fails. It's legally guaranteed unless the government fails or the company fails.